Hello, thank you. We won't shout too loudly. Anyway, welcome ladies and gentlemen to this special event here at the UN Climate Change Pavilion on Beyond the 100 Billion, Financing a Sustainable and Resilient Future. My name is Bob Ward. I'm the Policy and Communications Director at the Grantham Research Institute on Climate Change and Environment at London School of Economics. And we're here to discuss a paper by Professor Lord Nicholas Stern and on his left, Amar Bhattacharya, which is about a post-2025 climate finance deal. Let me start by apologizing that on Gender Day here at COP, it's 3 men up here. We've been unfortunate with our 2 female panelists who were not able to join us, and in the last hour our moderator has had to withdraw, so my apologies. Unless there's anybody here who wants to volunteer and come and moderate. Well, so our apologies. Anyway, we've got an hour, and we'll start by having some introductory comments from Nick and from Amar, then we'll go and invite questions from the audience. So when we come to the audience, if you put your hand up, I'll come to you with the microphone. This is being streamed live. So if you're not supposed to be at the COP, now is a good time to leave. But anyway, so we'll start with Professor Lord Nicholas Stern, who is chair of the Grantham Research Institute on Climate Change and the Environment at LSE. And then we'll move on to Amar. So, Nick.
Thank you very much, Bob, and let me thank the UNFCCC for making this space available and inviting us in. It's a privilege to have a UN-LSE joint seminar discussion. And let me add my regret, sadness to lose Laurence and Kate at the very late in the day. They would have added enormously to the discussion. We'll do our best to impersonate what they might have said at appropriate points. I'm going to start by looking back briefly to the 100 billion, but then looking forward, because this is about how we support the strong investment we need to make around the world, particularly in emerging market and developing countries in this decade that's coming. And of course, how we embark on a path that's not only for this decade, but goes on upwards after that. But let me start with the 100 billion. And just on a personal note, I was directly involved in negotiating the 100 billion in 2009 in Copenhagen. And I was working very closely with Meles Zenawi, the extraordinary Prime Minister of Ethiopia at that time, sadly no longer with us. And I was completely independent in the sense I was then, as I am now, a professor of economics at the LSE and acting independently of any government. But I worked very closely with Meles over many years before that and after that. And we tried to put together a plan which would help with the financing for the investment that was necessary in emerging markets and developing countries. And Meles at the time was speaking particularly for Africa and the African Union. We had a bigger number than 100 billion, and our intention was that it should all be public, and our intention was we should get halfway there by 2015. Remember, that was back in 2009. And also remember back then that people were talking about 80% reductions 1990 to 2050. That was the discussion then. We've learned better that we have to be much more strong than that if we're to tackle climate change effectively. But do remember that at that time, the science was very worrying, but not nearly as worrying now. I mean, it's difficult to find the right kind of adjectives. I mean, it was very worrying then, but it's extraordinarily worrying now. And the ambitions are higher. So when we look back and think about the 100 billion, and it being too small then, obviously it's way too small now, and what we want to look at is not simply the magnitude. In fact, our main point really is to look beyond the narrow aggregate, but look out at the kind of investments we need to finance. And that's where we start in our story of looking to the future. But before going to that, which is the main topic of what we want to discuss, the main purpose of our paper, obviously we have to deliver on the 100 billion and fast. It is a breach of trust that 100 billion has not been delivered now. And that breach of trust is very important. So the first thing to do is to deliver it as soon as possible. We do think that next year is possible, latest 2023, and that was the conclusion of the joint paper from Germany and Canada, their ministers, who described how that could happen. So before we leave the 100 billion, let's note that that breach of trust has to be rectified, and rectified fast. But of course we've got to move beyond that, and we've got to scale up and bring the right kind of finance to the investment we need. What is the investment we need? Well, we've been working away on that, particularly Amar with Homi Karas at the Brookings Institution. But roughly speaking, we need to be on a path for this whole story of net zero and the path to net zero. It's obviously not just 2050, it's all the way there. We have to be running investment in emerging markets and developing countries outside China. I mean, China's different, and we can come back to that. But emerging markets and developing countries outside China, the overall increment, extra investment has to be around 2 trillion a year. And of course, all the investment has to be sustainable investment. So we have to invest a bit more, and you have to change the composition of investment. That's the investment challenge, which is logically, analytically, practically at the heart of what we have to do to drive forward on development and deliver net zero. So this is a development and climate story. They're inextricably interwoven, and if we get the drive to net zero right, it will be itself the driver of a new form of development. Cities where you can move and breathe and be productive, ecosystems which are robust and fruitful, new job opportunities, much more productive use of resources. You know, the language of the circular economy is relevant here. So this drive to net zero is much more than a drive to net zero. It's a whole new story of doing development differently and extremely attractive relative to the way we've done investment in the past. But it doesn't happen without investment. It doesn't happen without the reallocation of capital. It doesn't happen without some dislocation that has to be managed, and a just transition that we have to think through. So what we're talking about here as an investment story is all of those things. Investment in natural capital, a lot of investment in physical capital, particularly in the energy sector, a reform of transportation, managing the just transition, investing in people and places to manage the just transition. This is the whole investment story that we're talking about. Of course, with natural capital and land being a very important part of all this. So this is a new development story that's in our hands. We can see it, and we can see the kinds of things that we need to do. It's not just increasing investment by 2 trillion, it's actually we're setting out the kind of investments we need to make. And we understand much of that now, and we'll understand much more along the way. We're going to learn as we go. So that's the prize. It is a new form of development, and it is one that's entirely achievable, but you've got to invest to get there. So the first thing then is to recognize those investments. The second thing is to ask how those investments can be drawn through. And that means that country by country, in some cases regional, but country by country, we as a world have to work together, but driven, of course, led by the country itself, to create the environment in which those investments can take place. They don't, you can't just describe the investments and they automatically happen. You've got to be clear that that's the path. We all know whether I mean, how many economists in the room? Anyway, you don't have to be economists for this, but expectations are absolutely fundamental to investment. Obviously, investment's about returns in the future. That means you've got to think through what the future looks like. So a big part of what we call the country platform for generating that investment is clarity about where we're going. Now, the world doesn't offer us certainty, but good strategy, good understanding of where we need to go reduces uncertainty. The right kind of policies will reduce uncertainty. The right kind of institutional structures will reduce uncertainty. Now, we don't get everything right in the UK, and I can give you a long list of what we've got wrong. But the climate change legislation and the Climate Change Committee is a way of putting together plans over time which give people an idea of where things are going. So if you want to invest in, you want to buy an electric car, you know, the net zero strategy, the Climate Change Committee story will help you understand how fast the whole charging infrastructure might move and help you have a discussion and press that forward. So a country platform is a description of where investment is going, a description of responsibilities within government, a set of policies, interaction with civil society around, for example, what a just transition means. And our friends in South Africa, with difficulty, strong internal discussion, but with success, have come through with a description of where they want to go in their new model of development, in their drive to net zero, in their driving past coal. So that whole story of where investment is planned to go. This is not a centrally planned economy. It's asking where investment's likely to go. And most of it will be private investment, and you're trying to stimulate the private investment through clarity of policy, the right kind of institutions, the right kind of governance, the right kind of involvement of civil society. And it's not fanciful. These things happen. And South Africa is one example. There'll be many more, and there are others. So that gives a chance to realize that investment. Final thing I have to say before I hand over to Amar about the finance of that investment is that a little bit on quantity and a little bit on private sector. I mean, roughly speaking, I said, $2 trillion of extra investment. Ballpark, and these are round numbers, and they'll come out as we move down the path. Chemin faisant, as our French friends say. But roughly speaking, half of that 2 trillion could be internal financed, and half of that 2 trillion could be external finance. The big majority of the finance, both internal and external, would be private sector. In most countries of the world, something like 80 or 90% of investment is private sector investment. That's the way the economies of the world function. Now, in some of parts of the sectors that we're looking at, it could be a bit more than 10 to 20% public sector, including in some of the infrastructure that's relevant here. But it's surely clear that the majority of this investment, the big majority of this investment, will be made and financed by the private sector, and big part of it internal, big part of it external. So that's the story of what investment we need, and it comes out of the objectives we've put for climate and development, and roughly speaking, where that investment will come from. So how do we put together and here we're talking about the external financing. We could talk about the internal financing, but that's for another day and another paper. But the internal financing will be very important, both public and private, but the external is the main topic of what that we want to describe here, and the different strands that go into that external finance. And different strands serve different purposes. It's not coming up with a number of 150 to compare with 100. All the strands we're talking about need to be pushed forward together, and they need to be used and designed together. And that is the right point, I think, Amar, to hand over.
Okay. Thanks. So I want to just elaborate on these different strands. A common theme is we need ambition on all of the strands. And a second is we need to combine the strands most effectively to push the kinds of investments we need. So in the paper, we talk about 5 strands. The first one, and that is foundational, is bilateral concessional finance. Why is bilateral concessional finance so critical? Well, you know, we have countries, particularly poor and vulnerable countries, that are starting out in a very difficult position right now. They are burdened by debt, their fiscal positions are extremely constrained, and investments in those countries will need high proportion of concessional finance. And this is particularly so, as we have heard in the last 2 days, for adaptation and resilience. And so for these countries particularly, the bilateral concessional finance needs to go up. Bilateral concessional finance is also extremely important as a ballast of risk capital. They help us get the risk capital, the guarantees that are necessary for blended finance, and they also can be powerfully combined with other forms of capital in pursuit of many of the kinds of objectives we are pushing. In the paper, we argue that bilateral concessional finance must aim to double between 2018 and 2025. So a good number for 2025, we think, is 60 billion. Is that plausible? Absolutely yes. The G7 has already moved quite a lot in that direction. They need to stretch more, but that's good. Without stretching, we are not going to get where we need to be. The second thing that needs to happen in the financing architecture is we need to ensure that the multilateral concessional funds that play a very critical role in the climate finance architecture have adequate and more predictable financing. At the moment, we lurch from one replenishment to the other. 2 big replenishments underway right now are the International Development Association, the IDA replenishment. IDA is the biggest source of concessional finance for climate action. So getting that replenished, you know, with robustly and with ambition, very important. IDA is going to put roughly about 30% into climate action. And we are aiming for 100 billion IDA. So that's number one priority. The other one that is under replenishment right now is the Global Environment Facility, one of the core facilities under the convention, under the UNFCCC Convention for Climate Finance. But we need to also buttress other climate-related funds, the climate investment funds. They are critical right now for scaling up action on coal. The Global Infrastructure Facility, critical for scaling up action on the energy transition and the build-up of renewables. And of course, we must continue to buttress the Global Climate Fund. There was a big push yesterday on the Adaptation Fund, a big commitment, especially by the European Union. We are very grateful for that. But getting a more coherent architecture around the multilateral concessional funds is the second piece. Third, we are absolutely not going to get there without a major revamping in the role and the financing coming from the MDBs in 2 important ways. First, they are the most important source of long-term public finance. And the beauty of the multilateral development banks is you put a little in and you get a lot out. If you put 38 billion one time into the multilateral development finance system, you can double their capital base by 700 billion. And with that, you can work wonders. That is the most powerful mechanism of international public finance that has been invented, and we are not utilizing it as much as we could. But the other, I mean, beyond the direct finance, the value of their finance at this point in time is they are they can mitigate, share, and pool, mitigate, and reduce the risks associated with investments. So getting the multilateral development banks to scale up is very important. We argue that between 2018 and 2025, multilateral development finance should treble in order to meet the ambition. Fourth, there is a massive opportunity right now to scale up private finance. As you heard in the on Finance Day here, the total amount of private finance now that is committing to net zero in this big drive that Mark Carney pushed amounts already to 130 trillion. Does it mean that's all money that is committed? No. It has to commit in the future, but we have mobilized a large number of private investors now that are interested in both the net zero, but also in financing investments in emerging markets and developing countries. We now need a stronger partnership between the private investors, the countries, and the public finance to be able to catalyze the kind of scale of finance we need. And last but not least, we have some innovative approaches that are on the table. The first of those is the use of SDRs, the special drawing rights that were approved a couple months ago, 650 billion housed in the IMF. Those SDRs can be reallocated by the countries that own them for the purposes at hand, particularly for climate at this point in time. There is a specific proposal now, which is called the Resilience and Sustainability Trust, to be housed in the IMF, but you could go beyond that in using the reallocated SDRs. Second, private philanthropy is coming to the fore. On the second or third day, there was an alliance that was announced. It's called the Global Alliance, Energy Alliance for People and Planet, led very much by private philanthropy in partnership with countries, in partnership with the multilateral institutions, with the aim of mobilizing 100 billion for energy access, energy transformation, jobs. And that's, again, a powerful new idea that's out there. And last but not least, we have the potential of using voluntary carbon markets. But here, again, we have to ensure that it's of the right quality, that we are not double counting, and that it is being used in a way that produces the results we seek. But we are at a moment right now where two things need to come together. We need concrete programs of investment, fit for purpose. That means, driving the transition to net zero, but delivering on an inclusive, resilient, sustainable growth path. And on the other hand, we need these pools of finance now to come together in a structured way so that we can deliver on the ambition at hand. We believe that COP26 can be that bridge where this idea can be taken forward concretely. Ultimately, it is one country at a time. South Africa has shown a prototype of that, but there are also vulnerable countries that are coming forward with programs around adaptation and resilience, and we need to also ensure that finance is fit for purpose in those countries. Thank you.
Thank you both very much. I should have mentioned that Amar Bhattacharya is based at Brookings Institution in Washington and is also a visiting professor practice at the Grantham Research Institute at LSE. So we have just over 30 minutes available for questions. So at this stage, I'm going to invite questions from the audience. So who wants to go first? And yes. If you'd like to say your name, any affiliation you want to declare?
Yes, no worries. So my name is Ian Cochran. So I'm a senior advisor, so I'll take this off, excuse me, at I4C Institute for Climate Economics, and also the director of the MSc in Climate Change Finance and Investment at the University of Edinburgh Business School. Really interesting presentation, and I now look forward very much to reading the paper, and I've already planned it into my course in the next 5 weeks with my students. one question I would have is that a lot of the ideas in here, I think, we've seen quite a bit of progress recently, but it's not necessarily something, not to be critiqued, but new in some respects. I was one of the reporters on the first Canfin-Grandjean report to the French presidency in 2015 at COP21, and a lot of the ideas that you've included here were also within the report that we delivered, which then got rolled into the One Planet Summit and the One Planet process and lab under President Macron. So for me, there's a question of, I think these are the essential ideas, so it's good to see them here again, but what is a way that we can try to accelerate this uptake and really try to move it forward, because we are at a point where we've seen progress around the questions of monetary policy, we've seen renewed mandates and capitalization for the MDB and the bilaterals, but we're still not quite at scale. So what are the, not even anywhere near scale, let's be honest. So what are the near-term wins that we might be able to do in the next couple of years to really make progress across these 5 areas, and what, might be kind of the kind of key steps for getting there, and what, out of this process over the next couple of days? Sorry, a little bit long, excuse me.
Let me begin, and then Amar, I'm sure will follow up. Perhaps particularly on the kind of coalitions, the practical kinds of coalitions that could put this story together. But what's different from Paris, and I should say I'm one of the quatre garants of the One Planet Lab, and Amar is deeply involved, so we do indeed take that process very, very seriously. What's different now is that we have a much clearer understanding of the kinds of investments that this funding is supposed to be supporting. And there's a G7 paper which we prepared for at the request of the UK Prime Minister for the G7 summit in Carbis Bay in June, which sets out some of these calculations, and that's been followed up with still more detailed and broader work by Homi Karas and Amar Bhattacharya. And that's where the 2 trillion number comes from for the flows of incremental investment that we need, that should be running at that kind of level in 2030 in emerging markets, developing countries outside China. So the proposal is tailored around the kinds of investments that need to be made. So it's not an abstract sum, oh, this is nice, this is nice, this is nice. I can name you 5 flows. Well, you can name 5 flows, and you could have named them a while ago. But the point is that these are being organized with the purpose of funding particular kinds of investments. And it's not just the aggregate, because we can see the different kinds of investments and thus can try to speak to the way in which different combinations of finance come together. A just transition needs a different kind of finance from a new electricity supply system. Actually, you're probably going to need them side by side, but they're different kinds of finance. Many of the forms of adaptation will need different kinds of finance, and we've got a better handle on what they look like too. So what's new here, and I think it is very important, is that this is combinations of finance for a purpose. And we can be much more clear in terms of the kinds of investments we need, all the way through from just transitions to big physical investments, natural capital and so on, and ask, what do we need in these different places? Now, philanthropy, if you excuse the analogy with the beer advert, can reach the paths that other forms of finance can't reach, including in relation to much of civil society. Amar started with the bilaterals and their importance of those in concessional finance. So what's different now is the clarity of the purpose, and thus you have a structure for thinking about these 5 different forms of finance and how they can be used. So essentially it's a question of, are we serious, are we not? Because if we've declared for net zero, for bringing climate and development together in this strong way, those are the investments we need. If you're not ready to make them, then your commitment to this whole story is a bit dubious. So we have to ask ourselves how that can happen, both in terms of drawing the investments through and the right kind of finance in the right place at the right time for the different elements. But Amar, over to you.
Thanks, Nick. So I just want to say one thing about, you know, as you said, what's new, and then I want to come back to the idea of how do we deliver. So on what's new, you know, we often focus on net zero by 2050, and indeed we should. But the other part of it is these next 3 decades are the decades of development. And let me explain why. Of the world's population of 7.9 billion, 5.6 billion are in the developing world other than China. And we will add 2 billion people in that group in the next 30 years. That's the biggest demographic transition we are going to go through, and we have to deliver on development at the same time. So the investments that Nick is talking about are investments that drive a better form of growth that deliver on both people and planet. They are not different investments. And even at Paris, we were not sufficiently clear on this point that these are not investments about climate and there are investments there about development. These are totally joined up investments. It's about an investment for a new growth path that delivers sustainable, inclusive, resilient growth and delivers on development as much as it delivers on climate. And the next 3 decades are those 3 decades, but we must begin now because, as Nick highlighted, underscored, urgency is the name of the game. Second, we need a practical way forward. So oftentimes in the discussions we have, people will say the problem is not money, the problem is we don't have good projects. We don't have clearly articulated programs. And on the other side, you know, many countries will tell you, we don't know where to go to for the money. We don't have the financing that we need. So we need a very well articulated structure right now that brings these two sides together. You know, realizing the investments and realizing the finance. And the partnerships that are going to deliver this have to operate at 2 levels. First, at the country level. As I said, you have to do it country by country. You need country platforms that are purposeful, that are driven on an objective, that tackle the policy and institutional constraints, that bring together domestic and international players, public and private. South Africa is a prototype of such a platform with high ambition, with all stakeholders at the table, from the government to the ANC, to the unions, to the business sector, to civil society. That's the approach of the future. But it is purposeful. It's around clarity on an investment program, the policies that will support it, and the international support that will be needed. The second point, and I'll stop on with that one, is you need also now global structures that can allow for repeating this country by country. We don't want to reinvent the wheel everywhere, and we are moving towards that structure. There are about 4 or 5 coalitions that have emerged in the last 2 years: Fast Infra, CFLI, Global Investors in Sustainable Development, and GFAN that was announced here. But they have to work ultimately with the public sector side to have a structure that we can go out and tackle this now in a much more predictable, replicable, scalable way. So I think the partnerships that we put in now have to be of a kind that are much better, stronger, and more predictable than what we have had in the past.
And let me add one thing about the processes at the international level for trying to make it happen. First, it's the UNFCCC, and this is something which we're convinced will be prominent in Egypt's leadership of the next COP. They're thinking hard and creatively about these issues, and we hope there'll be a translation and it'll be arm in arm with this COP and COP27. The second is the G20, G7. I put it in that order because obviously the G20 is a lot more important than the G7, but they both have a strong role to play. And I think next year with Indonesia and Germany in the presidencies of the G20, G7, we've got two countries which are very focused on these issues and very involved in those challenges. So there's a chance. And after that, we've got India and G20 and Japan, G7. So I do think that if we put our minds to it and understand what we need now, that those international processes could take it forward.
Thank you. So I'm particularly keen to have a female member of the audience give a question, the next question. So both of you, maybe you first and then. So if you'd like to say what your name is and any affiliation.
Yeah. Hi, my name is Cristina Tavales. I work at the OECD. As you know, OECD members, as well as G20 members, have recently agreed on an international minimum to tax corporations, which is a groundbreaking international agreement. I mean, it still needs to be written down, but I mean, as a matter of principle, it's groundbreaking. Do you see that as a possible model for a new system to finance climate change mitigation and adaptation? And what would you see are the main differences and similarities? Considering also the pressure and the urgency of reaching an agreement.
Yes. So, first of all, as Nick mentioned, the real starting point has to be domestic resource mobilization. And the minimum tax threshold has two major impacts, and they're related, and both OECD is central to both. One is setting a common standard that helps, in some sense, get individual countries to a level of taxation. But the other, as you know, is base erosion and profit shifting. And this will also greatly help in tax avoidance. So for developing countries, as you know, with illicit tax flows, this will be a very big deal potentially in boosting their domestic resource mobilization, including and especially in Africa. But there's a third element, I think, also where standards are needed, and that is in the equitable sharing of taxes. Particularly on digital taxation, which is going to be the biggest area. OECD, again, has been leading in that area. There has been a G24 proposal, as you know, also to try and improve, in some sense, the equity. But now the second question is, can we have a minimum standard in the area of finance contribution? Several proposals have been put forward around, what might be just contribution, related, for example, to cumulative carbon emissions. There have been many different proposals. I don't think practically that would really work in this space because the climate accords have such a strong history. It is better to begin with the climate accords rather than now come up with something completely new in the sense of contribution. But it is good, I at least look at those numbers to see how far off is what would be an equitable approach from where we are. And I will just be a little provocative and not mention, but there is a very big gap.
I also think that some common standards, including through Basel IV, on the treatment of risk, because you've got 130 trillion that's declared, and and probably a lot of trillions in there are sincere, perhaps not 100%, but a lot. And so they're looking for opportunities. And they've also said we shouldn't go in the dirty areas. But they can run into risk capital constraints or in those financial institutions. So I think we have to broaden that discussion of risk and how risk is managed, how risk is shared, and how risk is regulated in order to liberate that. And that, I think, is something that would be best done internationally with international standards. So OECD, I'm sure, could help with that.
Thank you. Hello. I'm Danielle Morley. I work for Bon Sucro. We're the standard and platform for sustainability in the sugarcane sector. So I have a couple of questions. One is I'd just like to have your view on the announced International Sustainability Standards Board and what you might think about, because when I heard the announcement of the International Sustainability Standards Board that's developing a standard for ESG disclosure around to enable this private finance to go where it needs to, it was very notable the absence of any conversation around impact. And as a sustainability standard, we know, a lot about how to measure impact, and it's a kind of a different approach and a different theory. So I'd quite like to hear about that. And then my other question is around accountability. Do you have any recommendations or considerations around how to ensure that this sort of tsunami of money and this incredible urgency is going to be spent with accountability for the people on the ground who really need it?
Thank you.
Yeah, it's only a potential tsunami. I mean, the intention to invest in this area has been articulated by something close to half of the capital under management. So I think it's a genuine shift in intention. But those investments don't happen unless people see the profitability of those investments, which is why the investment climate is so important. And the shareholders and managers of those institutions should be able to identify whether they're consistent with net zero, whether they're genuinely sustainable or not. And I think confidence is higher if the standards for assessment, and that would include, of course, impact, if the standards of assessment are shared. Because what we need to do is to move quickly and on scale. These big amounts of investment, they're not going to go off and do little project by little project in each country. So in those circumstances, the standards are particularly important, and standards which can be applied in big chunks to slices of that investment. So it is going to be very important. The principles of the Task Force on Climate-Related Financial Disclosure, I think, will be valuable here as well. But the TCFD by itself won't do that. So I think the new board will be of real value, and there's lots that can be done to help it along its way. But it is going to have scale in mind. It's the integration, as it were, of the integrity and the quality and the scale that's the challenge.
Amar, do you have anything to add?
Yeah, I'd say that I think standards are important. There's a new also sustainable infrastructure standard that has been, or label, that has been put out by the private sector. And I think that also will be helpful because it's important to move beyond ESG. ESG is good. It's a do no harm kind of a standard. But the sustainable infrastructure standard that I'm mentioning actually goes beyond, because it's more about what you need to do in a more positive way. And in a way, the EU kind of standards that's being pushed around the green taxonomy is a little bit similar. So there's a lot of work happening from the developing country point of view. Of course, it needs to be kept fairly user-friendly, otherwise it'll all kind of collapse on itself.
Yeah, all too often, Paris alignment is a negative list, things you should not do, yeah? When actually the big part of Paris alignment is doing the right things on scale. And that's the kind of test we have to learn how to bring to the story. Otherwise, it's just a tick box, and if you get enough crosses, or perhaps another way around, it's a cross box, and if you get enough cross boxes, you don't do it. But it should be much more positive than that.
Let's have a question here. Just wait for the microphone. Again, if you can say your name and any affiliation.
Thank you very much. My name is Mike Enskat. I work for GIZ, German International Corporation, in the infrastructure sector. Thank you very much. Highly interesting, very exciting. But I have one question, one element that I find missing a little bit in your overall picture. It's all like very much financing from the global system that goes into developing countries, emerging markets. but I think we also have to take the bottom-up perspective and the aspect of market reform, conducive investment environments. What do governments have to do in order to set up markets and incentives? And especially, for example, I'm working a lot on energy, and the energy market reform debate. I don't really see where this is going. You know, we had big reform debates in the 1990s. We have now the new business models, also due to the small-scale solutions that we find. But I think a lot has to be done in order to attract private capital that can be then de-risked by the public sector. But I would like to hear a little bit more on that if possible. Thank you.
Yeah, I think I'll pass most of that to Amar, but just to emphasize that what you're asking for was at the heart of what I actually said and what is in the paper. The country platform is about the sense of direction, the regulatory environment, the role of government, the investment climate. That's at the heart of the story. So recognize the investments, look at the environment, policies, institutional structures, governance, and so on that can pull it through, and then step over to the finance. So it really wasn't missing. It was at the heart of what we were talking about. You know, if you look at the South Africa case or the India case, the reform of the electricity supply industry, different in the different cases, will be at the heart of generating the private investment, which will drive most of the generation side of the story, but not necessarily the transmission and the and the distribution. But Amar, anything you want to add?
But most of my work actually is on the issues that you mentioned, but it's not the subject so much of this paper. But let me just say a couple things that are. First is, you know, we need robust policy and institutional foundations and a right kind of investment climate that can draw the investment through. In the particular case of energy, a common theme is that the utilities need reform. You know, South Africa, therefore, starts appropriately with utility reform. If you look at the energy program in India, can't do anything unless you sort out the discoms. So certainly we have to get the reform agenda square and center. There's also a financial market reform, and Nick Robbins, who sits here, can speak much more eloquently than I can. But getting domestic capital market reform so that we are actually able to hold these assets on a long-term basis will be fundamental. Now, the country platform is an intermediate approach to try and get these investments going, knowing that we can't fix all the problems in one day. That's what the country platforms are about. So we are very conscious that this is there are no shortcuts to deep institutional reforms, but we need to find ways so that we can get the investments going because we are out of time.
Thank you. Anybody else got any questions? We have just under 10 minutes.
I would like to hear a little bit about...
Do you want to just
sorry,
say your
my
name?
name is Ana Asti. I am from the government of the state of Rio de Janeiro. I'm Undersecretary of Water Resources and Sustainability. And I was wondering about the role of the subnationals states, because we have already a financial structure that help us through a fund to invest in sustainability. For example, we have an ambition to get to 441,000 reforestation in our program till 2050, and we have $100 million in our fund, but we need $5 billion to get there in 2050. So how we as a subnational could achieve this project? Do we have to wait the national to be ready to receive these funds, or is there any other way that we could think that we could, because we are in a hurry, we cannot really wait until there is something perfect in the national level, and in the local level we have our own strengths to build a system that is ready to be in the sense that you were the security that the investment needs. So just to know how you think about the local levels.
if you're asking us to suggest that the federal level is not perfect in Brazil, then I couldn't possibly comment.
Anywhere. Anywhere.
I think the subnational city levels are going to be extremely important. Some of the international institutions are not very well set up for that, but some of them are well organized. Before I went to be chief economist of the World Bank, I was chief economist of the EBRD, and we were quite well set up to lend to cities with or without a sovereign guarantee. And I do think that that's a place where the MDBs can and should make strong progress. The philanthropies can go where they choose to go. The voluntary carbon markets, you know, it would be supporting projects and programs wherever they are. So I think most of the elements, some of them already can go at the lower level now directly. Others need a bit of help in order to do that. But without naming any names, we had an earlier conversation this week for, you know, your regional development bank, Inter-American Development Bank, and those are exactly the kind of issues that were being raised. So I think there's a lot of thought about that. In some cases, it will need a bit of institutional enabling. But Amar.
So 2/3 of the investment will have to be made at the subnational and municipal level. And we do not have good financing structures to deliver that, either locally or internationally. So we do need, you're absolutely right, the Inter-American Development Bank and the World Bank have been focusing, but not yet sufficiently so. So I would continue to push on that as a very important aspect of the agenda, that we need financing structures that are enabling the local jurisdictions now to be, because this is about investment. And, you know, the structure of subnational finance is particularly weak with respect to that.
Thank you. So we've got just 5 minutes.
No, challenge them. Bring forward a good plan and challenge them.
We've got just 5 minutes left, so we've got time for one quick question and one quick answer. So who wants to be the final question of the session? Nobody. We've answered all the questions there are about the paper. That's amazing. Well, okay. Well, we won't carry on, I don't think. So just to mention that the paper is on the website of the Grantham Research Institute, so you can download it freely. There are also details of the author's contact, so if you have any follow-up questions, please feel free to get in touch. And with that, we'll be doing a Facebook Live interview. Nick and I will be doing a Facebook Live interview shortly, so if you want to tune in there. But just want to end by thanking the two panelists, Nick Stern and Amar Bhattacharya, thank the audience, and particularly thank the UNFCCC, Gaurav and his team, for having provided us with this opportunity this afternoon. Thank you very much, Gaurav and the team, and enjoy the rest of your COP. Thank you.
Thank you very much.